Dear students, we will do module 83, set off and carry forward of losses. So here, what do you mean by set off of losses? When any loss relating to any particular year is set off against income of the same previous year, it is called the set off of losses. For example, you remember if a person is having three businesses, two businesses he is getting profit and one he is getting a loss. So he can adjust that loss incurred in one business with the against the profit incurred in the other two businesses. Similarly, loss from one house property can be adjusted if he has more than one house property which is getting profit. So this is the set off of losses. So again, if you think about meaning of set off of losses means adjusting the losses against the profit or income of that particular year. So this is happening within the same financial year or same assessment year. Losses that are not set off against income in the same year can be carried forward to the subsequent years for set off against income of those years. So you have to remember, imagine one loss cannot be adjusted in the same assessment year. So what the SSC has another option, he can carry forward it for many more years. A set off could be an inter source head set off or an inter head set off. So one is inter source, second one is interhead. These two types of set off. So two types of set off, one is inter source set off, second is interhead set off. Now what is inter source set off? Inter source set off means adjusting a loss from one source against income from another source under the same head of income. Say for example, as I already told you, loss from one business can be set off against profit from another business. When a person is having more than one business, some are earning profit, some are earning loss. When income from one house property can be set off against loss from another house property. If a person is having more than one house property. Under the old tax regime, that self-occupied house property will be always negative or always loss. Next is loss from one capital asset can be set off against capital gain from other capital asset. This is subject to certain restrictions. We will explain that. So this is explained in section 70. Now the exceptions to this general rule. One is long-term capital loss can be adjusted only against long-term capital gain. Short-term capital loss you have to remember, but it can be adjusted with both long-term and short-term capital gain. Now speculation loss. Speculation loss can be adjusted only against speculation profit. Now specified business loss. Specified business loss meaning loss from warehouse, loss from agricultural go down or anything like that. If they are getting specified business losses which are specified under Income Tax Act. So one or two examples: warehouse loss, income from a warehouse loss, or income from anything related to agriculture. So specified business profits only that can be adjusted. So loss from owning and maintaining race horses can be adjusted only against income from owning and maintaining race horses. Now loss from an exempted income, it cannot be set off against income under any other provisions of the Income Tax Act. See, agricultural income is an exempted income, so it cannot be set off against any other income under the Income Tax Act. Then loss from casual income. Casual income meaning lottery, betting, gambling, all that cannot be set off and cannot be carried forward. Loss from deemed income. It cannot be set off at all. Deemed income we have learned how they are transferring assets to family members and all. We have already learned in detail. Now interhead set off. That means outside the head. So within the same head of income it is possible. Then some incomes against any other heads of incomes are also possible. That is why it's mentioned as outside head. So after the inter-source adjustments, taxpayers can set off remaining losses against income from other heads. Loss from house property can be set off against salary or any other head of income. So when I was in service, whenever I was my self-occupied house property, it was always at loss. So salary income I used to adjust with the self-occupied house property loss. This was under old tax regime. Business loss other than speculative business can be set off against any other head of income except income from salary. Then this is explained under section 71. Now there are also certain exceptions to this rule. Some losses can be set off against particular income or particular head only. Speculation loss cannot be set off with any other income. Then casual losses cannot be set off with any other income. House property only against income from other heads up to rupees 2 lakhs. This is under old tax regime. Loss from business or profession, it cannot be adjusted against salaries. It's already mentioned. Long-term capital loss only against long-term capital gain. Now, short-term capital loss, both long-term and short-term capital gains can be adjusted. Expenses on the maintenance of race horses only against profit from maintenance of race horses. Now, exempted incomes cannot be set off with any other income. Now, deemed income. Deemed income cannot be set with any other income. Now, sale of loss from firm or association of persons. Profit from the share of a partnership cannot be set off with individual incomes of the partners or members. Loss from sale of digital assets. It cannot be set off with any other income of the SSC. This is a new provision added in the Income Tax Act. So this is what I wanted to explain in this module. Happy learning. Thank you.